Hello and welcome to this video about sale and repurchase agreements, or commonly known, in short, repos. What is a repo? A repo is a financial transaction between two parties, typically a buyer and a seller, that involves the sale and subsequent repurchase of a security. It is a form of short-term borrowing and lending, taking place in the financial markets. After stating this, let's delve a bit more into detail. How do repos work? What is the process? The buyer, typically a financial institution or investor, agrees to purchase securities, for example, government bonds, treasury bills, or other highly liquid assets from the seller. Simultaneously, the buyer and the seller engage in a separate agreement specifying the date when the seller will repurchase the securities from the buyer. This repurchase date is typically in the near future, usually within days or weeks. Repos are usually financial instruments with a short time component. The seller agrees to repurchase the securities at a slightly higher price, which materializes into an interest component or so-called repo rate. The repo rate represents the cost of borrowing for the seller. The difference between the purchase price and the repurchase price, along with the duration of the agreement, determines the interest earned by the buyer. What is the purpose of doing this? Repos are often used by financial institutions, including banks and money market funds, for managing their short-term funding needs or to adjust their liquid positions on the balance sheets. They are also utilized by central banks as a monetary policy tool to control money supply and manage interest rates in the economy in general. From an investor's perspective, it provides the opportunity to earn, even though rather little, returns on their excess funds. There are different types of repurchasing agreements that vary based on specific terms and conditions. Here are some common types of repos. Overnight repo. An overnight repo is a short-term agreement where the buyer purchases securities from the seller with an agreement to repurchase them on the next business day. It is a very short-term transaction typically used for immediate funding needs. Term repo. A term repo has a fixed maturity date longer than overnight repos. The buyer and seller agree on a specific term, such as 1 week, 1 month, or even longer. Term repos allow participants to secure funding or invest funds for a specific period, offering greater flexibility than overnight repos. Open repo. In an open repo, the maturity date is not specified, but there is an agreement between the buyer and seller to allow the repo to be terminated by either party with proper notice. Open repos provide more flexibility as the maturity date can be adjusted based on the needs of the participants. Reverse repo. A reverse repo is a transaction where the seller sells securities to the buyer with an agreement to repurchase them at a later date. In this case, the buyer of the securities engages into a repo transaction, while the seller takes the position of the cash lender. Reverse repos are commonly used by central banks to absorb excess liquidity from the market. These are just a few examples of repo variations, and additional types may exist depending on specific market practices or local regulations. It's important to note that the terms and conditions of repos, such as the interest rate, haircut, collateral, and settlement procedures, can vary based on market conventions, counterparties involved, and specific regulatory requirements. This brings us to the role of the collateral in the repo transaction. The collateral plays a crucial role in repurchasing agreements as it serves as security for the cash lending or borrowing in the transaction. Here's how collaterals are typically treated in a repo. Collateral selection. In a repo, the borrower, or seller, pledges collateral to the lender, or buyer, to secure the cash received in the transaction. The type of collateral accepted can vary depending on market practices and regulatory requirements. As already mentioned beforehand, commonly accepted collateral includes government bonds, treasury bills, high-quality corporate bonds, and other highly liquid as well as low-risk assets. Second, the valuation of the collateral is an important consideration in a repo transaction. The parties involved agree on the valuation methodology of the collateral, which determines the amount of cash to be lent or borrowed. The valuation may be based on market prices, pre-agreed prices, or other mutually agreed upon valuation methods. The value of the collateral is monitored throughout the duration of the repo, and adjustments may be made if the collateral's value changes significantly. For example, the valuation of bonds takes into account accrued interest, so basically, accumulated interest that has not been paid to the investor since the last coupon payment date of the bond. Usually coupons of interest-bearing instruments like bonds are paid twice a year during the holding period. Third, haircuts are applied to the value of the collateral to account for potential fluctuations in its market value and to provide a margin of safety for the lender. Haircuts represent a percentage reduction in the value of the collateral that is accepted as eligible collateral. The specific haircut applied depends on factors such as the quality, liquidity, and volatility of the collateral. Higher quality and more liquid assets typically have lower haircuts, while riskier or less liquid assets have higher haircuts. Fourth, margin calls. During the term of the repo, if the market value of the collateral declines or if there are changes in the counterparty's creditworthiness, the lender may require additional collateral to maintain an appropriate collateral coverage. This process is known as a margin call. The borrower is then required to provide additional eligible collateral or cash to meet the margin call and ensure the lender's exposure remains adequately collateralized. And last but not least, custody and segregation. The collateral is typically held by a custodian or agent on behalf of the parties involved in the repo transaction. Proper custody and segregation practices are followed to ensure that the collateral remains safe and separate from the assets of the custodian or other clients. This segregation ensures that the collateral is readily available to the lender in case of default or other events triggering the use of the collateral. The treatment of collateral in a repo may also involve legal agreements, such as master agreements, for example, the International Swaps and Derivatives Association, or ISDA, master agreement, or other collateral agreements, which define the rights and obligations of the parties and provide legal enforceability to the collateral arrangements. The specific treatment of collateral in a repo can vary based on market conventions, regulatory requirements, and the terms agreed upon by the parties involved in the transaction. If the repurchasing agreement market experiences turmoil, it can have significant implications for financial markets and the broader economy. Turmoil or distress in the repo market can occur due to various factors, including market disruptions, liquidity shortages, counterparty risk concerns, or changes in market sentiment. Here are some potential consequences. Liquidity crunch. The repo market plays a crucial role in providing short-term funding and liquidity to financial institutions. If there is distress, it can lead to a liquidity crunch where participants struggle to obtain the necessary funds to meet their immediate obligations. This can create systemic risks and disrupt normal functioning of financial markets. Increased funding costs. During times of distress, the interest rates or repo rates in the market may rise sharply. This occurs when lenders become more reluctant to provide funds due to perceived risks. Higher funding costs can put financial institutions under strain, affecting their profitability and ability to carry out regular operations. Reduced market activity. Distress in the repo market can cause a decline in market activity as participants become cautious and limit their lending and borrowing activities. This reduction in market activity can have a broader impact on other interconnected markets, such as money markets and bond markets. Volatility and flight to quality. Distress in the repo market can lead to increased volatility in other financial markets as participants reassess their risk exposures. Investors may seek safer assets and move away from riskier investments, causing a flight to quality. This flight to quality can result in price fluctuations, particularly in the bond and money markets. Potential systemic risks. The repo market is interconnected with various participants, including banks, money market funds, and other financial institutions. If distress in the repo market persists or spreads to other parts of the financial system, it can pose systemic risks, potentially leading to financial instability or contagion effects. To mitigate distress in the repo market, central banks often intervene by providing liquidity support to participants. They can conduct open market operations, such as repurchase agreements or outright purchases of securities, to inject funds into the system and stabilize the market. Regulatory authorities also monitor and implement measures to enhance transparency, improve risk management practices, and address systemic vulnerabilities in the repo market. By stating this, we hope you enjoyed this video. Thank you for your attention. Keep in touch.